Hello, everyone. Welcome to this month's live market update. For those of you who are new to the show, my name is John Pasalis, broker owner here at Realosophy Realty. My team and I, of course, help home buyers and sellers across the entire Greater Toronto area make better real estate decisions. So if you have any specific questions of your own, like to meet with me and one of my team, you can click the link. We'll have that in the show notes below. So let's get started. Again, for those of you who are new, I like kind of doing these monthly updates. It's kind of like a real time look at what's happening in the condo market. We're going to have some on the ground. We're going to look at the monthly stats, I should say, first for the GTA. I'm going to kind of touch on the mid-month stats for May to look at what has even changed since April. We're going to talk about some on-the-ground trends with Gus and Davin from our office. Because again, I think it's important to understand, there's one thing looking at the statistics, another thing understanding kind of what's happening on the ground. And as always, we're going to have David Larock, mortgage broker, to talk about what's going on in the mortgage market, unpack any questions you have, where rates are going, and what we can expect on that front. So as always, we have Urmi Desai, our editor at Move Smartly, kind of managing the show. If you have questions, post them in the chat below, and we'll of course try to, we'll answer as many as we can as we're going throughout the presentation. Now, one thing I wanted to kind of mention, in the next couple of weeks, I'm going to be kind of talking about an issue that has come up on our monthly roundtables a little bit, and it's this idea that it looks like Canada's kind of propping up pre-con investors instead of letting prices fall. So this is going to be something I've been looking at some data on. I'm going to be kind of presenting probably a couple of weeks from now. So please keep an eye out for that. And the idea here, of course, is this idea that, a lot of people who go out pre-construction condos, 4 years ago or so, as they're completing, they're not really worth what people paid for them. And yet, they're closing. And I think what's happening is, banks are basically kind of supporting sort of these overvalued investment properties. We're going to kind of take a look at that and understand what's happening there. What's the cash flow look like on some of these newly built investment properties for investors, and some of the downsides of some of the things that we're seeing. So I'm going to be touching on that in a future episode in the next couple of weeks. So keep an eye out for that. Now, going into the latest numbers, again, we're looking at the numbers, of course, for April. And when we look at we're going to start off with the low-rise market, specifically detached sales. Last month, detached sales came in at just under 3,200. That is below last year, which is about 3,400, and 34% below the 10-year average of about 4,800 sales. So sales are very soft for detached homes, for low-rise homes. Of course, the 10-year average does not include 2020, which was of course quite low because of the COVID lockdowns. But even compared to the previous 10 years, excluding that, I mean, sales are 34% below. So very soft. And again, I think part of this is really just driven by affordability. I mean, it's very hard to afford today's prices at today's interest rates. And I think this is one of the big factors that's weighing in on this decline. Part of it could have been people hoping for, and something we talked about, rate cuts, sitting on the sidelines waiting for rates to drop, which would in theory make housing more affordable, because your mortgage payment will be lower. And that might be contributing a little bit to it as well. But of course, obviously, that's a very significant decline compared to previous trends. Now, if we look at new listings volumes for houses, they came in at about 7,500, well above last year. But last year was pretty much at a 20-year low in new listings. And it's one of the reasons why the market rallied last year in terms of price growth. So, but compared to the 10-year average, where new listings are a little bit below that 10-year average, probably about 8,800. We're about 7,500, so not a crazy volume of new listings. But when we look at active listings, we're pretty much in line with what is typical for the month of April. We came in about 7,600 listings, well above last year of 4,500. But again, the past few 3-4 years, listings were low for different reasons. I mean, in 2023, they were low just because very few people were selling. New listings volumes were at a record low. The previous years, listings were low because demand exceeded new listings, and that was sort of absorbing all of the inventory. So new listings volumes were quite low. So we're well above the most recent years. We're below 2018, 2019. That was a period when the market kind of cooled down and things were kind of soft. So active listings are below those levels, but generally somewhat in line with historical norms. So it's not terribly low. So when we talk about and we think about, we talk to buyers all the time, one of the concerns is, well, there's just not a lot to look at. There's not a lot of inventory to look at. Well, if you keep in mind that active listings are actually average and sales are 35% below average, really what's happening is I think a lot of people are just looking at what they can afford and thinking this is just, I don't want to pay these prices. And I think this idea that there's not a lot to look at is a lot of it is just driven by, I think, people's expectations of what they want, and prices right now are still quite high for that. And this is what's kind of keeping the market a little bit stuck. Months of inventory, which I'm going to talk about a little bit later on with more timely data, has been trending up. So again, months of inventory is just the active number of listings divided by the number of sales in that month. As months of inventory declines, the market's heating up. As it increases, the market's starting to cool down. And that's generally what we're starting to see. We're starting to see, so months of inventory started plummeting from sort of the fall to the beginning of the year. The market was kind of accelerating, and now we're seeing a bit of a reversal and things starting to cool down a little bit. And when we look at average prices for low-rise homes, about 1.23 million, which is down about 2% over last year. I'm going to quickly take a look at some of the condo stats. So the condo market is a little bit different than the low-rise market. So condo sales came in about 2,000, which is a little bit below last year, and down from 2,400, which is sort of the 10-year average. So definitely condo sales are down compared to historical norms, not quite as much as detached homes. And again, part of this is detached and low-rise are affected a little bit more because, of course, prices are quite a bit higher, which is weighing more on affordability. So even though condo sales are down, they're not down as much as detached sales. But when we look at new listings for the month of April came in about 5,500, which is a record high basically for the month of April. So we're seeing a surge in the number of listings hitting the market for condominium apartments. And again, part of this is, and I'm going to eventually dig into the data once I have some time, but most likely is investors starting to exit the market. I suspect investors who are renewing mortgages at higher rates are probably having a hard time affording their properties now, or maybe they're just not optimistic that rent and price growth is going to continue, so they're just exiting. And I think there's a big factor that's driving to the number of the new listings. And similarly, when we look at active listings are also at a historic high. 7,000 units available for sale in the GTA in the month of April. That's pretty much the highest it's ever been, which kind of goes along with obviously the new the listings increase. Similarly, when we look at months of inventory for condominiums is also trending up a little bit gradually. And average prices are basically flat year over year, about 750,000. So that is kind of a look at what the stats were like in April. I want to take a quick look at what the mid-month statistics look like, because it's kind of showing us which way the market's going, and I think it kind of does show us some interesting trends. So if we look at the number of sales for the first 2 weeks of May, typically we have about 3,200 low-rise sales. So that's low-rise houses detached for the first 2 weeks. Last year's 2,500. This year is just under 2,000. So sales in the first 2 weeks are basically down 41% from the 10-year average. So a very sluggish start to May, and even slower than, of course, the 34% decline that we saw in April. So things are cooling down when it comes to sales. And similar with condominiums, the condominium, not quite as steep of a decline from last year or the 10-year average, but sales are down about 27% from the 10-year average roughly. And again, the issue with condominiums is not so much that sales are plummeting, but new listings are surging. So on the low rise side, new listings and active listings are normal, but sales are plummeting. On the condo side, new listings are down about 27%, but sorry, sales are down 27%, but new listings are surging. So there's two different things going on in the market for houses and the market for condominiums. When we look at the months of inventory, again, I calculate this weekly because it kind of gives us an idea of which way the market's going when we're thinking about or we're concerned about markets changing direction, markets shifting. Again, we don't want to wait a whole month, because when you sort of analyze things on a more frequent time series, you start to see the shifts happening sooner. And that's kind of one of the reasons why we have these updates and why I do this, is that we see that for several weeks now, since the end of March, really, months of inventory has been gradually trending up. And that's a signal that the number of listings coming on the market is effectively outpacing sales, right? And that's why we're starting to see a little bit of an uptick in months of inventory. So what does all of this mean for buyers and for sellers? I think there's a couple of takeaways right now. And the first is that the market, as we're moving towards May and June, is very different from the market of 2 months ago even. The competition is slowing down. And again, I don't want to make it sound like everything's now a buyer's market and everything's slow, but it's definitely slowing down. The market is not as frenzied as it was. So if you're a buyer, you need to be more mindful of the fact that you may not want to go in, if you were going in aggressive before, you want to kind of be very cautious on your offer nights. There's more likely to be sales where especially for low rise, where offer nights fail. They don't get the number of bids that they want. So you want to be a little bit more mindful of that and, in some ways take advantage of a slowing market. If you're a seller, you want to be more thoughtful when you're pricing your home. I did a video recently, actually this week we published it, and we'll add it in the show notes, about thinking about how to price your home. Do you price it high and just take offers anytime, or do you price it low and get multiple offers? Again, every seller wants to price low and have 20 people bidding, but when the market's slowing down, it's not that easy. And sometimes if you're in a slower market, depending on the home, the better strategy is just to price it for what you want and wait for the right buyer. And we're getting close to that period where it's a coin toss when it comes to what's to do. Do you price low or do you price high? I think it's very specific to the home, as I mentioned in the video I published on Tuesday, the home and the neighborhood. But when the market's shifting and inventory is increasing, this is when you start, thinking a little bit more about, listing your property at the price you want, rather than just holding out and expecting, 20 people to bid, because that usually doesn't happen when the market cools down. So that's a little bit on kind of the latest trends. I don't know if we have any questions, Urmi, before we kind of bring on Gus and Davin.
Yes, we have two opposite ones.
Sure.
One from Visco. How long should long-term investors hold on to negative cash flow condos? Forever?
Oh my. This is a very difficult question. It's something I'm going to be touching on in the piece I'm writing on about investment condos. And this is the challenge. I mean, before, when I say before, I mean before 4 years ago, say, there is a lot, even though it seemed irrational to me, because I don't like holding negative cash flow. And just to unpack what we mean by negative cash flow, the idea with negative cash flow is that your rent does not cover your carrying costs, right? So you're making $2,500 a month in rent, but your mortgage, property taxes, all of that is $3,500. So you're short $1,000 a month. Now, in the past, investors would rationalize this for a few reasons. Number one, they'd say a big portion of that is going down to pay my principal. So that's not so bad. Plus, prices are increasing 5, 6, 7, 8% a year. So they're factoring in the capital gain on their investment property. Today, we're in a very different environment. I mean, some of the factors that contributed to the rapid increase in prices are reversing. I mean, one of those factors, of course, was leading up to 2019. We're in a period of declining interest rates. They picked up a bit in 2019, but then of course crashed, plummeted again and during COVID. So for pretty much the previous 10 years, we're in a period of falling interest rates, which helps push prices higher, and obviously improves the return for investors. The lower rates are, the more of your mortgage payment goes towards your principal. Today, we're in a higher rate environment, and while rates are likely going to decrease over the next 2-3 years, they're probably not going to decrease as aggressively or as low as they were in the past. So I think that's an important thing to be mindful of. The other is that, one of the things that has fueled rent growth and price growth is Canada's booming population. I mean, Canada used to be growing by about 350,000 people per year before 2015. And now we're growing by 1.2 million people per year. Like, our population growth has tripled. Now, our federal government in the most recent budget finally acknowledged that this is a bit of an issue, after housing experts have been saying it's not a problem because it's just a supply problem, that prices are booming. Governments realize it's not just about supply, that you can't triple your population growth without kind of completing houses first. So they're planning on scaling that back. And assuming they go ahead with their plans, a year from now, Canada's population will go from 1.2 million growth today to 300,000 next year. So it'll drop significantly. So this should, in theory, take pressure off of price growth. Again, today's prices are kind of, they bake in our supply shortage, but when you kind of pull back population growth, it should reduce the upward pressure on home prices going forward. So that's a long answer to say that the investor argument of holding on to negative cash flow properties is not as good today as it was 5 years ago. And I think it's one of the reasons why investors are exiting, because they're thinking, I'm holding this thing, I'm paying $1,000 or $1,500 a month. Rents are falling right now. They've been declining since August, and they might even decline a little bit more because we've got a ton of completions in the pipeline. And on top of that, it doesn't look like prices are going to grow very much over the next 2, 3, 4 years. So is it time to exit? And I think this is one of the reasons why we're seeing investors exit the condo market, why we're seeing this big increase in listings, because the math doesn't look as good. And you'll only, bleed $1,500 a month in negative carrying costs for so long before, without your property increasing in value, before you say, okay, forget about it, let's just throw in the towel and move on. And I think that's what we're starting to see. So to answer the question, is personal. I mean, I never was big into negative cash flow properties, and I think the numbers are looking a lot worse for investors as we move forward the next couple of years.
All right, and an easy one from the opposite direction.
Sure.
Let's see. Deepa V asks, taking a longer term perspective, supply is far behind demand. Owning a home is aspirational, and that will keep demand high. Immigrants continue to pour in. Given all of this, is it fair to say that on a long-term perspective, this is a good time to buy?
Gosh. So again, I think people have to kind of understand we're always going to have a supply shortage. Okay. I mean, we're not fixing this supply shortage anytime soon. We're, short kind of 3 million homes. And that is, of course, just to get us back to affordability. So but having a supply shortage doesn't mean prices are going to keep going up 10% per year forever. And in some cases, I think this is one of the problems with some of the pre-construction condos that are completing. They're not worth what people paid for them because prices have not gone up 10% a year. Condo prices are largely flat over the past 4 years. So, I would not think about this in terms of, future growth. I mean, I think if you want a home, buy a home personally. I mean, again, it may seem irrational. I mean, if it was me, even if prices don't go up over the next 5, 6, 7 years, I want a home, I want a home my own. It doesn't make a difference. So I would buy for that reason. If you're considering investing, again, I think there's just a lot of things to keep in mind. Today's prices, like I said before, reflect the housing shortage, right? So if population growth declines to 300,000 people per year, this just might mean prices stay flat again, because today's elevated prices bake in this idea that we have a housing crisis and a shortage. House prices in Toronto are 10 times income. So if our population growth eases, it doesn't mean we're going to go to 15 times income and prices are going to surge. It likely means price growth will moderate quite a bit, right? So, and all of that kind of comes down to this idea that real estate might be a far more boring investment over the next 2 to 3 or 4 or 5 years. It's probably not going to be this lottery ticket that so many people have kind of cashed in on over the past 6, 7 years. That lottery ticket was largely, everyone thinks it's because everyone's a great real estate investor. No, it was a government fueled price growth, largely driven by plummeting interest rates and a tripling of our population growth that fueled price growth and rent growth. Not because we're all geniuses. Anyone could have bought any property and done well. And I think those factors are likely not going to be as important in the future, which means real estate will likely be a far more boring investment. So if you're fine with more modest growth or flat growth or whatever it is, then go for it. But I would not be expecting prices to surge. Just my opinion. But again, assuming government sticks to what they say they're going to do.
Thanks, John. We have some great questions coming in, and I think they'll fit after you bring Dave on very well.
All right, let's bring in then Davin and Gus for now, just to chat a little bit about what we're all seeing on the ground with our own clients. Guys, how are you?
Well, how are you?
Beautiful, beautiful. So, Gus, you're on my left on my screen, so we'll kick it off with you. Maybe unpack some of the things that you're seeing with your clients, buyers, sellers, as we're moving into the market in May.
Yeah, for sure. So, we're working with quite a few clients, whether it's freehold or condos. What I'm seeing in the last, I mean, this isn't a normal spring market. I think you've kind of already outlined that. It feels a little bit like 2018, and for people who don't know what 2018 was like, 2017 was a crazy market where everything was kind of increasing, and there was a lot of FOMO, and prices were growing quickly all over the GTA. New rules were implemented by the government to such as the stress test and a few other things. It kind of took I guess took the air out of the market, so to speak, calmed the market down. And then 2018 was just sluggish. And that's what this feels like. And to use a word, I mean, I don't know, I'm not trying to be dramatic, but it feels like apathy has set in. Mm-hmm. People are just, and I don't blame them. People, a little bit of that, a little bit of uncertainty for sure. Or, we're going to recession. People thought rates would go down already. They haven't. Now they may not go down till we may only see 1 or 2 rate drops this year. So all this stuff has kind of really put the brakes on buyers jumping in. Investors for sure, there's not many around, and for the reasons that you described, even the ones that are around understand they're going to be buying with negative cash flow. Some of them are okay with that because they want to hold long term. Others not so much, and they're looking for deals. And then that leaves first-time home buyers and people who are upsizing or downsizing. And there's very few of those that have the income, that have maybe the stomach to go into the market and pay these prices. And their main motivation is to get into the right school district or to get into a neighborhood where their family is close by to help with the kids. Or as I mentioned, they're first-time home buyers and they just don't want to keep moving or paying rents. So they're looking to buy their first home. And so unless there's that motivation of what I just described, everybody else is just kind of like, yeah, I would like to move to either a bigger house or another neighborhood, but it's too expensive. But how much am I going to get for my house? Am I going to sell at the price that I want? But I got to pay X amount land transfer taxes. But rates are still high. So there's a lot of indecisiveness and apathy and uncertainty that we're seeing. And I think that's why sales are low.
Yeah, I think you're 100% right, and I think that does reflect the mood in the market. This apathy. I mean, it's hard to get excited about paying some of these prices when you're paying 5+% on your mortgage rate. And I agree with you. And I think like you said, like the people that are moving largely are people who just kind of need a home. Like where timing the market's not important. It's just like I got another kid, or we're getting married, or we're up, or you know what I mean? Like they need another home. They need a home. And that's largely who's buying. So I agree with you. So that's a pretty good assessment. Davin, what are you seeing kind of with your clients?
It's hard to follow Gus's absolutely perfect, spot on answer. Honestly, it was perfect.
Thanks, Davin.
That's exactly it. The people who are active and who want to transact are motivated by things like kids, or current kid entering school, or any number of things. And their reasons for not doing so are the exact ones that Gus outlined. I can't even think of another thing to add to that, to be honest. I think the people who are going to find success, all right, maybe this is anecdotal because I'm going through it now. It's people who are leaving like a better market like Toronto and moving into like North York region, right? Going from, nice spot in like the Danforth up to like Newmarket, you're going to basically take something that is, much smaller, maybe fewer bedrooms, whatnot. You're just you're almost making a trade, right? Mm-hmm. There's really not much difference in the price points for what people want. And those are people who are going to find success. And other than that, there's nothing to look at. There's, people are, they're just kind of, throwing in the towel a little bit and just say, I'll do it later.
And you mentioned actually something also, speaking of Newmarket, like in our last weekly sales meeting, you mentioned something I thought was super interesting about agents in Newmarket or listing agents kind of suddenly kind of chasing you and kind of, following up with buyers. And maybe you can unpack that, which I thought was quite interesting and a bit of a shift that again signals, I think, a slowing market.
Yeah, so in your charts, what you don't see is all the little regional differences. GTA is obviously very large, and you lump that in with like the Newmarkets, the Burlingtons, the Durhams, and downtown Toronto. But what you don't see is just the crazy variance that you get across those towns and cities. So Newmarket specifically, only because I'm active there right now. We're just seeing listings just piling on top of each other, just piling up. And these are like nice 3 to 4 bedroom homes. Most people are listing with an offer night. They are almost inevitably failing. And then they're just scrambling to try and get their price. And they sit there and they sit there. And they may or may not drop down, depending on the motivation of the seller, to eventually sell for what I have to assume is about 150 grand less than what they initially probably wanted. And these are people too who listed back in 2023 for, let's say, 1.4 million. If they're successful this year, it's selling at like 1.25, right? And I'm not saying their house lost that value. It's just they were wrong in their price. And to your point, where people are chasing agents around, they need to drum up an offer and get these listings sold. And whether it's the agent or the seller who are not coming to reality, or the seller themselves, that remains to be seen every time. So you might see, across a certain area and type of home, just as a variance of prices, and it all depends on seller motivations, right? One house is going to sell for seemingly cheap, and the rest are going to sit there and either leave the market or not sell at all.
There's so many important things, I think, with what you kind of touched on, that the average person, I don't think kind of appreciates, understands, because we're like in the weeds of the market and are seeing, and I think there's two important things, both from a buyer's perspective and a seller's perspective. Number one, buyers can take advantage of kind of these micro differences in the market, right? So, and again, to Davin's point, what's going on in Newmarket is not necessarily what's going on in Pickering, and it's not necessarily what's going on in Burlington or downtown Toronto. Completely different things. We read the news and we're like, oh my God, shortage or whatever the story is, but it doesn't matter. Like you can have these coincidences where some markets have this surge in listings, some have a shortage, all at the same time, right? And if you happen to be looking in a market and you're a buyer in a market like New Market where there's a ton of inventory, well, listen, the reality is some of those out of those 50 sellers, some of them are kind of desperate, right? And when we say desperate, we mean that they maybe bought another property and they need to sell their current home one way or another. So as a buyer, you stands to benefit, if you are potentially kind of taking advantage of someone else's kind of distress. Because listen, if you're a seller and you bought another home and you need to sell, you're feeling anxious if there's another 30 homes like yours on the market and you're getting 3 showings a week. So yeah, to Davin's point, when the agents are calling, this as a buyer agent, you can kind of take advantage of some of these differences, some of this anxiety, and perhaps get a price that's lower than what you would have gotten in a normal market. Now, similarly, if you're a seller, and this is one thing we talk about in our weekly meetings, we talk about, should you be buying a home first or should you be selling a home? And this is always this tension, and oftentimes in the GTA, people go out and buy a home first, and then they list their current home for sale because, it's usually harder to buy and, easy to sell. But sometimes these trends get reversed, and this is a very good example. So, if we had a client, for example, who was looking at buying in some other market but had a home to sell in New Market, like it would be a red flag to go out and buy now if you need to sell in an environment that's a lot slower because you're less confident what you're going to get. You're competing with a ton of other people, and I think, again, this is where I think when people are trying to time 2 transactions, they need to understand the very local dynamics in the market that they're selling in, to see if there are some red flags like these that's going to make it harder for you to sell, and obviously the dynamics in the market that they're buying in. So again, I think these are things that a lot of people just don't think about, but I think are critical.
Mhm.
Going through that now with a couple clients, so it's something that we're luckily one of them's buying and selling and looking to buy and sell in the same neighborhood. So the dynamics aren't so different, but definitely when it's in a different neighborhood, yeah, you got to slow it down and comb through to see exactly how many showings and how many offers those similar homes that you're going to eventually try to sell are getting right now, and if it's going to change.
Yeah, and I think the challenge is that the advice can change because the market can change. Like you can start by obviously planning to buy first and then sell. And sometimes I've been in cases where like our clients are about to make an offer. I'm like, by the way, like the market in your area has shifted a lot. There's a ton more inventory. I'd be more cautious, and sometimes they just go ahead with the purchase or not. But sometimes the dynamics do change, and we need to be thinking about that kind of in real time. Any other interesting stories you guys had with clients recently? No?
I mean, speaking to your investor client, I have a client who's, I guess, investor-ish. He wants to buy a condo, but he's not rushing to really move in.
Mm-hmm.
And what we're finding, at least on the areas we're looking in, is there's a higher propensity of listings coming up where mid-June happens to be the preferred closing date, and I wonder why that is. I think a lot of people are trying to get out from under the additional capital gains tax that's coming up. So it was really funny how we have run into quite a few of those.
I think.
You froze there for a sec, Joe.
All right, am I back?
Yes, you are.
All right. Yeah, interesting. People trying to get out of the. I mean, that's going to be a tough one. Oh.
I've seen some say in the comments, close before June. I think what's the deadline? June 25th.
Yeah.
Close before June 25th, and there's like an extra 3,000 commission or something.
Yeah, I was going to say the extra incentive baseball.
I don't know if that's going to help, but I mean, I think at this point, the seller should just, if that's their motivation, figure out that sweet spot between lowering their price and what their capital gains is going to be before June 25th, and get it done that way.
I actually think people are making emotional decisions without even doing the math. Like for the average person, it's not going to be like, unless you're making a ton of money, right? Like the average condo investor is not making that much more than 250 or 300 grand for it to be such a big difference, you know what I mean, in gains. If you're making $1 million, I mean, fine, but those are harder properties to sell anyways. So super interesting how people are reacting. Urmi, I don't know if we had any questions for Davin and Gus before we bring David on.
Oh, everyone was so clear and brilliant.
All right, beautiful.
As Davin was saying, there's nothing left to say. No, I think that was a really good on the ground addition to explaining what those numbers look like. Thanks. And we have a few more questions coming in about interest rates, so we'll save those for Dave.
All right, awesome, guys.
All interest rates. Who cares?
All interest rates this week. All right, guys. Thank you so much for your feedback.
Cheers.
Thank you.
Mr. Larock. We have
Hello,
David.
sir.
All right. So David Larock, mortgage broker extraordinaire, joining us once again, always with the great blog posts and the great one-liners on our live updates. Welcome, David. Thanks for joining. Let's kick things off with your latest blog post and your latest thoughts on the market, the jobs numbers, how all of this is going to potentially impact sort of the bank's upcoming decision, and maybe even what you're thinking about the Bank of Canada might be doing in their next rate decision.
Sure. Well, John, the market is on tenterhooks, and basically every time a new data point is released, if it was stronger than expected, then yields pop, and if it was weaker than expected, then yields plunge. And there's a lot of overreaction. There's a lot of shooting first and asking questions later. And the employment report we received last week is an excellent example of that. The headline said that our economy created 90,000 new jobs, which was 4 times more than forecast, and bond yields shot up. When you do a deeper dive into the numbers, there were actually some trends there that suggest that the Bank of Canada is not going to overreact to the latest employment report. For example, wages have been growing by north of 5% for quite a while, and last month they only increased by 4.7%. They had risen by 5.1% year over year in March. So that's a slowing in average wage growth, which if continued would be an encouraging sign. We have so much immigration, as you mentioned earlier on this podcast or on the call. We need to create 60,000 new jobs every month just to keep pace with our population growth. And we haven't been doing that. We've been adding more labor supply, adding more workers much more rapidly than we've been creating new jobs. So when you look back over a longer time horizon, we have a lot of excess labor capacity that's being added to the market. Now, last month, even though we added 90,000 new jobs, the unemployment rate didn't change. And that's the reason why we're adding so many more workers than we're finding jobs for them, that even in a month where we have banner employment growth, it doesn't lead to a drop in unemployment. So again, Bank of Canada looks at this stuff with much more measured analysis. Another thing last month that was concerning was we lost 10,000 jobs in the goods producing sector. Goods production, manufacturing creates service jobs. On average, it creates one job in manufacturing, creates an average of 2.5 jobs in the service sector through downstream demand that is created from that goods production. We're losing jobs that actually make things, and there will be a downstream impact on service jobs a little bit farther down the road. Again, we saw a weak GDP print. It said that our economy grew. Originally in January, it was estimated, StatsCan estimated that our GDP grew by 0.5% in January, which would be a pretty solid monthly print. That was revised down to only 0.2. And now it looks like January was revised down from 1 to 0.5. In February, our GDP only grew by 0.2. And in March, we didn't have GDP growth. We were flat. So there are lots of signs showing that things are slowing down. The employment headline, I don't think ultimately the Bank of Canada will react with the same I don't call it enthusiasm, but will overreact like the bond market did. And I think whatever plans they had, and this is what I said in my blog post, whatever plans they had going into last week, I don't think the employment report altered those plans. We've got slowing inflation, slowing momentum, lots of expanded capacity, a loosening in labor market conditions. All of these factors have the consensus expecting the Bank of Canada cut. The question is when. They're meeting next on June 5th. The market thinks it's a coin toss whether they'll start cutting then. The Bank of Canada, of course, is worried that if it does cut, it's going to ignite the housing market, and they don't want to undo the momentum that is causing inflation to fall. But the reality is the Bank of Canada has to skate where the puck is going, and its rate hikes hit the economy with a lag of anywhere from 18 months to 24 months. And whatever they're doing now isn't about now. It's about what the economy is going to look like next year and the year after that. And one of the things the Bank of Canada talked about recently as well, John, and this is something I've mentioned in recent blog posts, and I think I mentioned it the last time we chatted, only about 50% of Canadians have renewed their mortgages thus far. And the 50% that have renewed rates that were about 3.5%, and they're renewing into rates that are about 5.5%. All up, that's an increase in payments of about 20%, and Canadians have managed that. Default rates are still below historical long-term averages, and the situation is under control. People are feeling the pinch, but they're able to continue to make their payments. The 50% of mortgages that have yet to renew are going to increasingly be the ones that were originated back in 2020, 2021, those pandemic low rates that were below 2%. Now, those borrowers aren't going from 3.5 to 5.5. They're going from 1.5 up to 5.5. Those people are going to be much more impacted. So if you're the Bank of Canada and you know in the next year or two, there's an example, by the way, of why BOC rate changes hit the economy with a lag. When they hike their rates, a lot of folks have to be up for renewal first before they actually benefit from those lower rates. And when they hike, the additional cost is foisted at the end of the current term. So basically, the Bank of Canada knows this is coming. It's in the pipeline. It's already baked in. And they're expressing some concern about how Canadians will handle that when the impact on their cash flows doubles from what it's been thus far. We're all whistling past the graveyard, or a lot of people are. Soft landing wasn't as bad as we feared. Canadians are doing okay. Well, the real brunt of those rate hikes, at least from a mortgage standpoint, is still in the pipeline. We haven't seen it yet. And that, I think, is what the Bank of Canada is weighing when it says, okay, does inflation give us a window? Are we low enough now that is inflation low enough now that we can be confident it won't reverse? We don't want to see a resurgence. Is growth slowing sufficiently? Are we seeing enough capacity being added in the labor market that, yeah, wages are still too high based on productivity rates and where we think they need to be long-term, but they're falling now. And with increasing labor capacity, we think that that's a trend that'll probably continue. And the question is, now do we skate where the puck is going and start worrying about these mortgage renewals, which are coming down the road? And I think the answer to that question is yes. I think they are very concerned. Well, they've said they're concerned. The question is, will they start cutting? I don't know if it'll be June. I think it'll probably be July, and I agree with the market that I think it's a virtual certainty that we'll see at least one cut by September. And then once they start cutting, obviously the question then is how many cuts. And I can offer a theory on that, but I don't want to hijack the whole chat here, John. So I'll let you steer us where you want us to go.
That's helpful. I mean, the banks, you know, on the interest, and maybe we'll just touch on one more thing before we go to questions because we're 1:45. You know, the banks seemed like they were confident that people could handle these hikes, which I thought was kind of interesting. So I think, you know, in the past, maybe 2 weeks ago, they came out with a report kind of talking about how they believe that Canada can manage the increase over the next 2 years. And I was curious what your thought. I mean, obviously, anyone who renewed at 1.5% or 2%, I mean, if they've owned their home for 10 or 15 years, are not going to have a problem, obviously. It's the people who bought 4 or 5 years ago at 1.5% or 2% that I'm kind of wondering how they're going to manage sort of in this new rate environment. The property hasn't probably gone up too much since then. So what are your thoughts on kind of their outlook about people being able to manage this such a big increase?
Well, I guess we have to define what manage means. I don't think that we're going to get a raft of defaults and that house prices are going to drop by 50% and that we're all going to be guarding our vegetable patches with rifles. But I do think that people are going to be pinched, and more so than we've seen. If the slowdown in the economy we've seen thus far is a reflection of the payment shock that the average Canadian borrower who's had to renew thus far has seen, then you can double the slowdown going forward if the shock on borrowers doubles as well. The reality is the borrowers who got their mortgage rates at 1.5% or 2% were stress tested at 5.25%. So they're renewing mortgages that they've had on average 5 years to pay down, so lower mortgage balances. And they had to pass a test 5 years ago that ensured they could afford rates to be 5.25%, and they're about that now. A lot of folks, especially first-time buyers, people who bought houses 5 years ago and they haven't seen the kind of house appreciation they were hoping for yet. Those borrowers are typically young, and 5 years later, a lot of them have higher incomes. So again, I don't think it's a matter of, we're staring at a wave of defaults here, but I think the impact on those borrowers will be significant. I think it will slow the economy by more than expected. And I think the Bank of Canada is going to wake up one morning and say, whoa, wait a second, we've over-tightened. Now we really have to start cutting. And that's why I think variable rates are going to fall by quite a bit when all is said and done. I've said this in many posts. The longer the BOC waits to start cutting, the more I think they're going to have to cut by when they do start cutting. But by its own analysis, the Bank of Canada believes that its policy rate is in a neutral position at about 2.5% to 3%. Right now, it's at 5%. So neutral for the bank, their definition of neutral means our policy rate is not stimulating growth in the economy, but it's also not restricting growth in the economy. When we get a recession and a sharp slowdown, the Bank of Canada does not stop at the neutral rate level. It goes below the neutral rate level because it's over tightened. And at that point, it's trying to stimulate the economy to get it back growing again. So if neutral is 3.5% to 2.5%, and typically if we get a recession, which I still believe we will see, it goes below that level, then we're talking variable rate. We're talking a Bank of Canada policy rate in the 2% range, and that's about 3% below where it is now. The Bank of Canada is not saying that. Governor Macklem has said, we want Canadians to expect that if we start cutting, we're not going to cut by as rapidly as we increased. But I would say two things. Number one, I don't think we're going to see pandemic era lows in the Bank of Canada's policy rate. I don't think we're going back to 0.25%. But the Bank of Canada governor will do what the economy tells him he has to do. And this is the same guy that told us back in 2020 that rates weren't going up for a long time. So let's not put too much weight in his claiming that the rate cuts will be won't be dramatic and he's not going to cut by as quickly or by as much as he's raised. I think realistically, there's about 2% worth of air easily under the Bank of Canada's policy rate when it does start cutting. And the timing of when that'll happen, it will depend on whether or not I'm right and the Bank of Canada is over tightened and the economy slows by more than the soft landing forecasters are expecting.
David, the one thing I'm most optimistic about is that no one's going to be guarding their vegetable gardens with a rifle. I think that was the line, which is great. Urmi, I'm going to pull you on for to see what questions, if any, we have for David.
I have my own questions. It's like Beatrix Potter gone mad. Okay, let's go. One quick technical one, Dave. You talked about people facing higher interest rates that are renewing. Are they also looking at, for those who had their amortization periods extended, perhaps because they had the kind of mortgage that would help them keep their payments lower, would they have to now see that amortization come down upon renewals?
Technically, yes. So if let's say you started with a 30-year amortization mortgage 5 years ago, and you're up for renewal now. If you do a straight renewal, the remaining amortization is 25 years. Lenders are offering a lot of flexibility about re-extending borrowers back up to that original amortization of 30 years, and that would help those borrowers. And while a lot of them would technically have to requalify, there is a little bit of fudge factor allowed. So most borrowers are okay there. I think the question is about borrowers who took variable rates with fixed payments, and the variable rates started out below 2%, and now they've gone way up to 6% or higher. The question is, those amortizations are like 500-year amortizations, and they're the ones that the newspapers put the headlines about, which we're never going to continue. Basically, when you come to renewal, your amortization schedule is reset if you were on a fixed payment variable. Your mortgage will be bigger than it was when you got it, because that shortfall every month, your minimum payment wasn't even covering the cost of interest. So you have to renew a larger mortgage. Now, most of those borrowers did reset their payments and are no longer adding interest to their mortgage each month. The lenders were flexible for a while, but they have gone to most of those borrowers. So it would be unusual to have a borrower who has a mortgage that's bigger than it was when they started, and with a payment that is not even covering the cost of interest. But in answer to the question, yes, that payment has to be reset. It has to be reset to a 25-year AM or possibly a 30-year AM. So basically, that borrower wasn't even covering the cost of interest. They were completely unaffected by rate hikes, and when they're up for renewal, they have to catch up. Now, those borrowers aren't required to repay all the principal that wasn't paid down during the first term. There's some Pollyanna stuff out there where people are coming up with these crazy scenarios. That's not going to happen. But they will be the most impacted borrowers. And the Bank of Canada, if you go to their website, actually did a study and showed what they expect the payment shock for that group of borrowers to be. And that's certainly the most vulnerable area. And when the Bank of Canada looks at where the vulnerabilities are, that's the most vulnerable area, is variable rate borrowers with fixed payments who haven't adjusted their payment. Not a lot of them left, but if you're one of those borrowers, you're in for the biggest payment shock for sure.
All right, thank you. And another question from Misha. What happens when you sell a property at a significant loss? How does the seller who now owns the lender money proceed? I have seen some transactions with 100K losses.
Well, you've got a shortfall at that point. The lender has the right to pursue you for the full repayment of their mortgage, and they can come after you for the money. So basically, it's like any other debt that you owe. It's not forgiven because there was a loss. You have to take the loss. You have to make up for the shortfall.
Right. And let's just pin you down, Dave, between Chris's question and Dash. What will happen in June? I think I was hearing you're thinking they would stay put, probably. And then how many cuts by the end of the year?
Well, I mean,
I know you love that.
Yeah. Yeah, I think the market would be surprised if they go in June. The Bank of Canada kind of got permission to wait till July when the employment report caused the market to think that it wasn't going to cut. I think the bank still wants to take as much time as it can to let inflation keep falling. The hard part is, guys, the CPI print that's going to come out next week. If that is soft, I think they're cutting. If the CPI it doesn't go down or goes back up, the CPI Consumer Price Index, the measure of inflation, I think it really comes down to that report. So if the CPI index surprises on the weak side, I think they're cutting in June. If it doesn't, I think they wait till July. And how many cuts this year? Hard to say. I mean, the irony is, guys, if they cut in January, February, and March next year, the cuts didn't happen this year. I think realistically, they're cutting by anywhere from 1.5% to 2% between now and probably December of next year. How many of those cuts will happen this year? 2 or 3 would be my guess. But again, I think it's, if you're deciding on fixed versus variable today, I think it's much more important to be comfortable with the idea that rates are going to fall over the next 18 months, not so much when the first cut happens. That's a distraction. A lot of people, we talk about that too much. It's not, the first cut isn't the thing. It's the total cycle, and it's once they start cutting, there'll be more to follow. So it's really the total of the cuts that will determine whether variables beat fixed.
Thanks. And a final question. Are you seeing new home buyers, or is qualifying still difficult and they are still on the sidelines? John, earlier with your agents, Gus and Davin, you were talking about most buyers are in a need to buy situation if they're facing some kind of lifestyle change,
Yeah.
a new child or so forth. What about those new first-time buyers?
I mean, they're still out there. Definitely, that's kind of part of the market. I think they're just, like I said, they're constrained by prices. And what we're seeing is even when homes have 6, 7, 8 offers, in most cases, the prices are measured, they're conservative. There isn't this insanity where people are throwing just money at homes like, like it's free the way we saw sort of 2 or 3 years ago. People are calm because they just can't afford to be aggressive. So yeah, definitely first-time buyers are still active. And again, many of them are just, buying for lifestyle reasons. They just need that first home.
Yeah, I've seen a pickup, Urmi. I'm doing more pre-approvals. I have purchases now. I would say the market is in the last few weeks has definitely picked up. And the advice, here's something that borrowers have to think about. Everybody's waiting for rates to drop. And if you're a borrower and you're saying, I'm waiting for rates to drop, well, when rates drop, two things happen. You and all the other people who were waiting for rates to drop suddenly run into the market. So welcome back to the bidding wars, which were the bane of every buyer for the past decade. And also, when rates drop, if everybody can afford to borrow more because rates have gone down, then prices go up. So you end up paying more for the house. Congratulations, you saved on your mortgage, which is part of your cost, and you paid more for the house, which is all of your cost. So I use an expression these days. You marry the house and you date the rate. So even though rates are a bit high right now, if you can get into the market and marry the house at a better price because you don't have to win a bidding war, well, get a 3-year term, and in 3 years hope rates are lower, and then you can date a new mortgage rate and stay married to your house.
David, you kind of nailed what I think has been one of the funniest things about the mortgage decline narrative is that the views from buyers and sellers are completely different. And you kind of nailed it. Like the buyers are thinking, I can't wait for rates to drop. Homes will be more affordable. I'll be able to spend more. It's a better time to buy. And every seller thinks, I can't wait for rates to drop because buyers are going to flood back into the market and my home price is going to go higher. And we actually hear this every day. Like the seller's narrative is, I can't wait for prices to race to fall because my home's going to be worth more. Whereas the buyers are just kind of laser focused on their payments. And it's just kind of interesting that, the two groups that are most active are kind of taking slightly different things away from what might happen. I personally don't think prices are going to rally even if rates drop. Like I think it's going to be a tough market for a little while. But yes, in theory, like over the next 6 months, we're not going to see much. If rates drop by a full percentage, 1.5% over the next 12 to 18, well, yeah, I mean, that period, you're going to start to see buyers jump back in because that's quite significant, right?
Well, the other thing, John, is if the Bank of Canada is slashing rates by 1.5%, the economy is not in a happy place. And if people are worried about losing their job and the Bank of Canada is cutting because the economy needs stimulus, that does not correspond with a booming housing market. So
exactly. Yeah.
One thing for sure, if rates drop, buyers and sellers will not both be happy. I can promise that. Only one. Hopefully one group will be happy, but I'm sure it won't be both groups.
Very true. Very true. Awesome. David, well, thank you so much again for joining us and for all your insights. Urmi, thanks for managing our questions. And then all of you, thanks for joining and for your questions every month. If you have any additional questions, you can shoot me an email at askjohn@movesmartly.com. Otherwise, we'll see everybody same place next month. Thanks again, everyone.